and welcome back to the FOW European Derivatives Conference. I'm Philippa Shipley, Product Developer at Global Investor Group. Turning our attention now to the popular topic of ESG, I'm delighted to welcome Toby Belsom, Director of Investment Practices at the United Nations Principles for Responsible Investment, who will be moderating the Hollow Green Revolution, a critical look at ESG. Alongside Toby, we have guests from DWS, Anthropocene Fixed Income Institute, Matter and NN Investment Partners. Don't forget, you are welcome to ask our panelists questions via the Q&A function, and we'll do our best to answer them all. Please also remember that these sessions are being recorded and will be available to view on demand. Now I'd like to hand over to Toby to begin this session.
Thank you, Philippa, and good morning and welcome to this panel entitled The Hollow Green Revolution, a critical look at ESG. We've got 4 great panelists for you this morning to discuss a range of issues relating to ESG and derivatives. And those topics include performance and returns. Does incorporating ESG factors really add value? On greenwashing, how can investors using derivatives and other financial instruments avoid criticism around greenwashing and respond to new disclosure regulation that's largely developed for listed equity markets? On portfolios, what is the role of derivatives in an ESG portfolio? Is there one? And finally, on the role derivatives can play on allocating capital and facilitating capital flows to projects that contribute to climate solutions and sustainability. We'll welcome questions as we proceed, so please place these in the question and answer function on your computers, and we'll come to them at the end or introduce them as the panel proceeds on its questions. Before we move to the discussion, I wanted to introduce our panelists. Jeroen, Head of Responsible Investment at NN Investment Partners. Dr. Erlandsson, founder of the Anthropocene Fixed Income Institute. Roelfien Kuijpers, Managing Director and Head of Responsible Investments and Strategic Relationships at DWS. And Niels, Fibæk, co-founder of the data consultancy Matter. On the panel, we've got over 75 years worth of capital markets experience, and that should provide for a really insightful discussion. My name is Toby Belsom. I'm a director at the UN Principles for Responsible Investment, and I'll be moderating the discussion this morning. So let's move to that discussion and our first topic, which was around performance and returns. As ESG grows and matures as an investment approach or a factor within investing, inevitably and rightly, the focus on its merits increases. How does the panel respond to critics that ESG does not add value and is in fact a passing fad? Roelfien, maybe I can turn to you on this, having had an extensive experience dealing with clients of all shapes and sizes, and I'm sure debating that question with them over probably a 20-year period.
Yeah, thank you, and good morning to everyone, and also good morning to my fellow panelists. It's a very good question, Toby. I've been involved with responsible investments and ESG investing for the last almost 20 years at this point. And yes, you always hear the criticism, is ESG sort of, is it about fluff? Is it a fad? Will it be here, gone tomorrow? And one of the first points I always make to our clients who are asking these questions is that ESG investing is really complex. This is not easy. We're dealing with an enormous amount of complexity. At DWS, we wrote a study back in 2015. One of our portfolio managers went back to university, and together with the University of Hamburg, we wrote a meta study looking at ESG and corporate financial performance. We looked at over 2,000 studies since the early 1970s. And what these studies showed that companies that embed ESG principles in the way they operate ultimately over time have better corporate financial performance, and that leads to higher investment valuations as well. We redid that study, or we updated the study in 2018, and again the evidence was overwhelming, and actually it's, I think, the most cited academic study at UNPRI. At least that's what Fiona Reynolds, the CEO, always mentions. So there is a direct link to corporate financial performance, but let's just look at the E, the S, and the G. So if we look at the E, we look at environmental issues. We have seen following the COVID-19 pandemic, an increasing focus on climate issues, very much related to the COVID-19 pandemic. We as humans were not able to deal with the COVID-19 pandemic as we probably should have. And the climate issue is clearly a slower burning issue, but it's an essential issue to the future of us as humans and the future of the planet. And when you think about environmental issues, just the acceleration that we've seen over the last year and a half of governments making commitments to net zero. The UK government having been the first government to put that into law, the EU followed, China followed, the US is back in the Paris Climate Agreement. President Biden is talking about net zero commitments as well. And as these commitments are being made by governments, they ultimately fall into the realm of public policy making, regulators are picking it up, and companies are making net zero commitments as well. We at DWS, for example, were a founding member of the Net Zero Asset Manager Alliance, which was created in December last year. And so as governments, public policy makers, regulators, and companies are making these net zero commitments, we have to be cognizant of the fact that that net zero commitments impact every country in the world, every economy in the world, every sector of the economy, and ultimately every company. It's not just about stranded assets in oil and gas and coal companies. It is the supply chain of many different companies are impacted. And that ultimately leads to valuation issues. And of course, the most pronounced example is that Tesla has a market cap today that is greater than the entire global automotive sector combined. And we now all see governments are going to phase out combustion engines and diesel vehicles. Some countries are making these commitments by 2030, 2035. So within the next decade and a half, we will see this wholesale shift to electric vehicles. And that's just one example, but I can take many other examples. Think about fast retailing, for example. More and more consumers are taking the point that that is not good for the environment, and that has started to result in companies, for example, who are more embedded into recycling of clothes. And whether it's the agricultural, it doesn't matter which sector of the economy you look at, every sector, every country, every company is ultimately impacted by this transition, this climate transition from a high carbon to a low carbon economy, and decarbonization is ultimately going to impact not only companies and countries, but it's going to impact all asset classes. If we look at the G in ESG, you know, we can think about those companies that significantly failed on corporate governance, whether it was an Enron, whether it's a WorldCom, or more recently a Greensill type company. I mean, corporate governance really matters. And that same study that I referred to earlier, which any of the viewers can access on dws.com, that study also shows, for example, for emerging markets, it's the G in ESG that's the defining factor of better corporate financial performance. And then if we look at the S in ESG, we've all seen an increased awareness as a result of the global pandemic on issues around social inequality. Climate inequality has led to social inequality, and there are many other reasons for social and wealth inequality. There are issues around human rights violations, and all these issues ultimately lead to reputational risk, which can again lead to significant negative impact on companies. So ESG is very complex. So you're dealing with an enormous amount of complexity, and it's not a fad. As fiduciary asset managers or fiduciary asset owners, it is upon us to ensure that these type of risks, but also the opportunities that come with this transition, are embedded into our investment processes, are embedded into our company valuations, and ultimately the asset classes that we invest in. So the key message really is ESG investing is not a fad, it's actually highly complex. And the more the market starts understanding the complexity that investors are dealing with, the more hopefully adoption of ESG will ultimately take place across asset classes across the world.
Thanks, Roelfien. Also, I wonder whether I could turn to you. Just you've got kind of extensive experience trading and investing in various fixed income markets and use of different financial instruments. What's your perspective on that connection between ESG and returns in the market that you've been operating in?
Well, there are several perspectives on this, of course. First, I think, one should remember something when you're looking at these performance measures, that I think it's enough to prove that ESG strategies are not underperforming significantly. So there's always this try and chase out the alpha out of ESG. And, if you're thinking you're making the right investment decision from a sort of almost moral or philosophical ground, and it doesn't cost you anything, why shouldn't you? That's the first part of this question that I think is quite relevant when you try to frame, performance measures, etc. I want to touch something also that I've seen in my sort of investment activities when I used to be a portfolio manager with regards to ESG factors. It's very clear, and I'm from the bond side, where governance factors, governance or lack of good governance is actually what kills you in terms of bond portfolio performance. It's the real big blow-ups. It's usually very highly correlated with governance failures. So that's sort of an obvious. And then in my own little story, when I was fairly long in front-end CDS protection, or actually, so I was long risk in Volkswagen in 2015 in September, and you had the Dieselgate blow up. It's very clear that it sort of affects environmental factors will affect the bottom line of your trading P&L. So there is something there. Now, whether we are able to actually measure and pinpoint that performance differential, that's a different question. I have a couple of papers that I've written on it. And I think we should also realize that hard ESG guidelines in your investment portfolio, that will reduce the opportunity set, how much you can trade. You might not be able to go long risk in a big coal mine, for example. That just mathematically will reduce your alpha opportunity set. The question is, though, is that a significant reduction? Does it really matter in the greater scope of things? And the measures we have say it's not really reducing your opportunity to generate alpha in a significant way if you design these type of things smartly.
Thanks, Ulf. Niels,
maybe two things to briefly add, Toby. Firstly, I would say, if you look at these academic studies, they always try to find out if there are correlations between ESG scores and financial performance. I think it's important to at least be mindful that ESG scores, of course, if you look at the different ESG providers, have low correlation, so might be more of an opinion than a fact. So if you do the correlation on one data set, you might get a positive relation. Do it on the other data set, you might get a negative relation. So it's difficult to capture sustainability in simply one number. And secondly, maybe as a thought, simply higher level, environmental, social, and governance aspects that are material, so hence have an impact on the long-term profitability, cash flow generation capabilities of a company, have therefore also an impact on valuation and longer-term share price performance. I think as an active investor, you would always want to integrate it because it's basically giving you a more complete picture of the investment opportunity with regards to opportunities and risks. So I think it's basically in line with your fiduciary duty to take these material aspects on board. And that's, of course, is also a bit of the art to figure out which ones are material, which ones are less material. And that's, I think, what active management is about as well.
Thanks, Jeroen. Niels, your focus is around data and managing data. We talked, well, the three other panelists have talked around, trying to identify specific factors and the correlations between those and returns. Could you give us a little flavour about your own thoughts around the importance of difficulties around data and really identifying correlations?
I think Jeroen hit it pretty much on the head here. Is one of the classic problems has actually been that if you do try to roll up, let's say 60 or 80 or 100 or 120 different data points about a company on anything from carbon emissions to waste to water to human rights, labor rights, governance, etc. You try to roll that up into one methodology, you will certainly get to different conclusions. Just like if the panel here had to, let's just say, value E, S, and G on a scale from 0 to 10 for a company, let's say Tesla as an example, we would arrive at different conclusions, and that's also the problem for ESG. And as Roelfien also put it very clearly, ESG is sort of not a spice you can put on top of your portfolio, and then you'll arrive at sort of overperformance or underperformance. But what I think will happen, and what I think is interesting, is there's a big push now from the data side for much more granular data. So our clients are not interested in an overall ESG rating. They don't want, as Jeroen also said, they don't want us to do that interpretation for them, because that is more of an interpretation than it's an analysis or a fact. They're more interested in having access to underlying data and do that analysis themselves. And that is also very much in line with what is happening from a regulation perspective with the EU taxonomy and SFDR coming to the fore. So that is very much how I see it. And I think that will also, as we'll also discuss in more detail, what has also happened over the past couple of years and what will continue to happen is that clients will be able to have much more specific focus on one particular ESG factor or that they want to incorporate into their ESG portfolio, not only on a headline level, but take more sort of specific stances almost in their portfolios. And that will be interesting to follow.
Thanks, Niels. Maybe moving to the next kind of topic to keep the discussion moving along a bit, and that was around greenwashing, and particularly kind of marketing or being transparent about what funds provide to clients. And Jeroen, I'll point to you here because I know you've got your background in the CFA ESG disclosure standards, which are likely to be a point of discussion in this area over the next 6 to 9 months. But when the industry's gone through such a period of exponential growth, repurposing funds has been a big fad, or big trend last year. The use of new financial instruments, whether they be green bonds and new fund launches, are all based around different standards, all using it's very open for accusations of greenwashing and not clear marketing of product. What steps do investors, particularly in derivatives really, and other financial instruments, need to take to avoid those criticisms? Jeroen, maybe turning to you.
Yeah. So I think it's a very topical discussion in the market as well. Of course, ESG is hot, so from a marketing perspective, you want to bring this forward, which then increases the risk of greenwashing as well. So really making it a marketing gimmick. I think if you look on the derivative side, I think it's really important to have a good sense of what the underlying assets the derivative represents basically are. So in practice, for example, you could have a sustainable equity fund that excludes tobacco. But if you, within that fund, then use derivatives on a universe that actually includes tobacco, that's a bit in conflict with each other, or that is in conflict with each other, of course. And clients in those funds very likely want to stay clear of that. So you need to be mindful of basically the universe that the derivative is built upon. And that then touches basically on the need for transparency. And I think there in the market, it's twofold. On the one hand, you have the corporates, the companies that basically have already done a lot of steps in the last couple of years to disclose more when it comes to carbon, when it comes to other sustainability metrics, but also need to take a lot of additional steps to help investors improve the insights there as well. So on the corporate level, I think we need a push around reporting and also consistent reporting, so you can actually compare the data of the different corporates. And then on the investment fund side, I think there's also a clear need for increased transparency. Because today, of course, you can label every fund as a sustainable fund or an impact fund. but you can do very different things in practice for those funds. So as you mentioned, for example, one of the initiatives in the sector is the CFA Institute initiative, which actually yesterday published their paper for review in the sector. So I would really recommend everybody that is listening in to have a look at that, give your feedback as well. Really a framework to improve transparency when it comes to investment funds. So really try to improve the transparency when it comes to, okay, what are you actually doing when you say you are a sustainable fund? Are you integrating ESG? Do you have actually impact goals? Are you aligned with the SDGs? So what are you doing in practice? So I think there the sector can and should improve further. I think regulation there helps, and sector initiatives like the CFA Institute is helping a lot as well.
Thank you. Roelfien, I don't know whether you want to kind of add to that in terms of the role that regulators particularly play in this landscape. Rolfien, how do you know?
I was not necessarily going to discuss the regulation, so maybe I'll leave that part to Ulf. But I was going to comment. I think Jeroen gave a very detailed answer and clearly looked at the greenwashing within the fund industry, and also touched briefly on greenwashing within the corporate world. And I just wanted to pick up on that second point. Clearly at corporations, there are many corporations who sign up and assign themselves a number of the SDGs. They may sign up to all kinds of international environmental standards, for example. They make commitments to net zero, but there is also an element of companies who see this as a marketing ploy. And so the role of investors is very important in working with companies and making sure that this is not just a marketing gimmick, but that they really deliver on the plans that they set out. Or if companies are not willing, for example, oil and gas companies that are not serious about the transition to net zero and are not necessarily putting an aggressive decarbonization plan forward, investors play a very important role. And so the point that I'm going to make is more for equity investors, but clearly through engagement and stewardship and be a more active owner of these companies, you can have these debates. We've just recently seen conversations around ExxonMobil, conversations around Shell, and they can lead into different directions and different shareholder resolutions that are being put forward at AGMs. But the role of an investor to engage with companies to prevent this greenwashing is also really important, because you go to the source of ultimately the company and the financial instruments that you can invest in. The second point I'd like to make is that particularly when it comes to environmental issues, I think the TCFD, the Task Force for Climate-Related Financial Disclosure, has really played a very significant role of trying to put standards around how companies need to report. And we at DWS are not only very focused on the climate agenda, but we're also very focused on the nature agenda. And I really look forward to seeing the framework that the Task Force for Nature-Related Financial Disclosure is going to come with early next year, because the more transparency there is around data at the company level, the more data providers can be more accurate in analyzing that data to be used by investors, or for investors to interpret that data directly themselves.
Thanks, Roelfien. Also, I think you kind of stick your hand up on that one as well.
Yeah, so to say the current status is pretty backwards when it comes to some of these claims that are being made on the front of pension funds and similar, and then when you actually look through what's in there, but it's quickly changing. We worked a case earlier this year where pension fund, the Scandinavian pension fund, even making very big sort of climate alignment commitments on their webpage, marketing that to their clients, and then someone indicated that their bond book wasn't looking, their fixed income book wasn't looking anywhere close as good as their commitments or their equity books. which was actually true. I mean, they were shockingly full of tar sand and fracking companies in terms of their bond portfolio lending, which we made a story about. And we think that's, that type of transparency and understanding that, ESG goes further than just the equity side of the balance sheet. So that's the first thing. It has to migrate out into the other asset classes and also the derivatives exposures, OTC, etc. there. But the interesting part here was also that the domestic regulator called us and said, this is really interesting because we're starting to look at these greenwashing issues and greenwashing sales pitches or green sales pitches from the asset management and pension industry. And we are, with the SFDR and so on, we are going to start to look after this. So things are changing pretty rapidly, which I think is quite comforting to know.
Well, maybe I'd kind of slightly put you on the spot here. Roelfien mentioned about engagement as a process and stewardship. Clearly that's straightforward in listed equity markets. You just go and talk to the management. Fixed income, you might talk to the debt issuer or the lead finance director. But derivatives, what kind of mechanisms are they around to engage with management to try and promote better practice? Or do you think that kind of sits outside the responsibility of investors within that financial instrument?
No, and again, let's take the fixed income perspective, right? When you do derivatives, you do synthetic bonds in some sense. And that actually affects where the underlying bonds trade. So you can't have too much of a basis. So you sort of, if someone is extremely short through the credit derivatives market, that will sort of push up bond spreads on the underlying bonds as well, which then affects, cost of capital for the borrowers that are under there. So, the short side, for example, can be a very powerful sort of debt denial force and type of engagement that we see on the fixed income side. And I think it's extremely relevant. You'll see some of the, more macroeconomic, non-sustainable stories like, for example, Southern Europe in the mid-10s, the speculation around, Portugal, Ireland, Greece and Spain, Italy, etc. That was mostly driven by actually derivatives and hedge funds playing derivatives versus those countries. And then it sort of migrated into the actual cash instruments. So it's an extremely powerful engagement tool. And you shouldn't think that, what I do in derivatives does not matter, because it does, definitely within fixed income at least.
Thanks, Ulf. Niels, we kind of, again, suppose the answer to greenwashing is transparency, and good data is really important on that. Again, coming back to that key kind of question about quality of data.
I think there's a couple of sort of trends at play that will be interesting and will probably change the opportunities within greenwashing or for both companies and investors to sort of greenwash what they're doing. And one of the things we see is that there is a shift from sort of the definitions and the threshold for sustainability are moving from a private sphere over to a public sphere. And the way we think about that is where, as we talked about, ESG scores typically being calculated and provided by private actors, in a few years' time, a lot of the frameworks that investors will be held accountable towards in the public sphere will be defined by multi-stakeholder partnerships between regulators, civil society organizations, non-governmental organizations, etc. That will be, in my perspective at least, holding investors accountable to a much larger extent in the public light. And a second point to mention here is that what we have seen is that one thing is, of course, what companies themselves report. And if we look in a global context, we also have to look at what are sort of the critical voices in the room saying. So what are sources around the company saying here about the commitments that companies are making, as well as investigations into different practices that might be controversial or problematic. So for us at Matter, the question is also in finding out what does companies themselves say and what does the critical voices in the room say to get sort of the full picture on that. And then I think you're right on transparency. There's a lot more calls for both from clients and from regulators for being able to look into sort of the underlying information basically here and asking a lot more specific questions, where a few years ago you'd ask for an ESG or sustainable product on a headline. Now you'll be asking very specific questions for, as Roelfien mentioned, on, let's say, net zero commitments. All right, that headline is not good enough, but I want to know the 2025 targets, I want to know the 2030 targets, and I want to see where those are heading, and are the short-term targets aligned with the long-term vision? So the questions will be a lot more transparent, and that means there'll be less places to hide, basically.
Thanks, Niels. Jeroen, I mean, greenwashing, the regulators noticed this kind of coverage of greenwashing, quite rightly so in some cases, I suspect. There's a whole series of kind of pieces of regulation which have been around for some years now, been in development for some years. I just wondered what if our audience here who maybe are new to this field, which bits of regulation would you flag as being really key in terms of I suppose the overall approach to funds, but maybe specifically to derivatives?
So looking at regulation today, I think SFDR is of key importance in terms of transparency, and not only with regards to classifying funds as being category 6, 8, or 9 in terms of the level of sustainability and sustainable goals, but also later on reporting in that respect, also on the EU taxonomy. And the percentage of assets that have exposure to EU taxonomy. So that I think will improve quite significantly. What you also see, of course, is on a country level that, for example, in France, they have additional requirements. In Belgium, they have their towards sustainability label. Germany is looking as well at initiatives. So you do see on a more regional level also a lot of initiatives. On the one hand, I think transparency is always a positive thing. On the other hand, I was hoping for, let's say, European consistency. And now it looks a little bit like we will have a European standard and then per country have some differences again. So that could potentially, again, create a little bit of additional complexity in terms of comparisons. Hopefully we'll stay close to a European standard, because I think in the end for the users of the data and the insights, that is best.
And just to add to that, I mean, we shouldn't forget what's been coming out of the SEC in the US the past couple of months as well. And that's where it gets really scary. If you get caught greenwashing by the SEC, then it becomes, quite expensive. So that's another leverage point that I think, we ourselves will actually use in some of the language when we're, discussing ESG controversies. Because if you cross the line with the SEC and under New York regulation, it's not a fun place to be.
No. Thank you for both those. Going to give you a little bit of a non-European perspective on that, because clearly there's lots of shifting sands in the US kind of political thing, which is contributing to that type of moves by the SEC. I wanted to move on to our next topic, which may be a bit more focused on derivatives in a sense, and the explore kind of the role derivatives have to play in ESG portfolios. And how can you explain, or investors explain, the role and benefits effectively that derivatives can bring to investment process or strategy or fund? And we touched on an engagement process as well, which maybe it's useful to reflect on. But before I do that, though, before we launch into that, and maybe I'll turn to you first, Ulf, just to flag, as you're listening in, the organisers have put out a poll. Please feel free to answer that as you're going on for the next half an hour or so. Ulf, maybe turning to you.
Yeah, so I'm going to go back to this, that if I can use an ESG derivative and it doesn't cost me anything really, then why shouldn't I? I mean, if there's some sort of positive benefit to it, potentially, and there might be a marketing benefit even, why shouldn't I? Now, this actually puts quite an issue when it comes to how derivatives tend to be structured today when it comes to ESG, because all of them are, like the ESG E-mini future or the iTraxx ESG index. They're all trying to single out the positives, so the sort of the strong ESG components. But for me, when I was trading at 8 before, the main usage of derivatives was in terms of using it for hedging, which means that I would take on short positions, which makes it quite the opposite what I want when I want to buy protection on something. I want to buy protection of the shit ESG index. I don't want to buy it on the good ESG index. And that's a little bit where, you know, the product development has become quite lopsided, because it doesn't sort of provide us with the product that is actually needed. And you can see that very clearly in the CDS market, where the iTraxx ESG CDS index has not been a huge success, if you put it that way. And I think it's just, you know, it's constructed for being inputted into structured products, not really for the main sort of flow usage that I would like to see it, because then it would have been constructed on the other side instead. So that's a thing, I think. And then, you know, we just need to ramp up. We put out the research note yesterday, actually, with, you know, with CDS relative value trade on a sort of an ESG theme. And I think that's quite interesting, and you can use quite a lot of derivatives for this sort of relative value trading on the ESG factors. And if you're successful in that, that's also a very interesting usage of the instruments.
Well, just following up on that, you mentioned about going short a specific sector, perhaps using a derivative as an instrument for that. Did you see that as equivalent to divesting from a sector for a long-only manager?
Yeah, I mean, it's from the fixed income perspective, there's a very sort of clear limit argument why, you know, being shorted derivatives is the same as being underweight, or actually as in, you know, being short in cash as well. You can make like these the arbitrage arguments around it. So there's a very clear linkage, which I think we should consider definitely much more.
Thanks, Toby. Roelfien, I know DWS will manage portfolios for a whole different range of clients. I wondered what, and ESG portfolios particularly, I wondered what role derivatives play in those portfolios, whether it be institutional, retail, or...
Yeah, no, happy to answer that. I'll just switch asset class for a minute, because, you know, there are all kinds of different derivatives, and we are also a very large investor in real assets. So, for example, in real estate and also in infrastructure. And in these real asset markets, for example, currency and interest rate swaps are essential instruments for real asset investors to mitigate currency and interest rate risks and stabilize the cash flow profile of the underlying assets. And then if we look at these derivatives markets in mature economies and in mature markets, they're plentiful. But when we shift to emerging economies that are often exposed to much higher country risk, they tend to have less liquid and more expensive derivative markets. And that presents a structural limit to long-term investors targeting illiquid assets in emerging markets, where in essence the need for sustainable real asset projects, for example, to mitigate the impact of physical climate risk is much greater. And, you know, it's been interesting to see that governments, for example, the Indonesian government is currently working on supporting the access to tools to stabilize currency risk for private investors, for example, to invest in the country's greenfield infrastructure projects. So I think derivatives play different roles in different asset classes. But for example, when you want to allocate more capital to climate change mitigation and adaptation strategies, we need to ensure that, particularly for emerging markets, there's access to more liquid derivatives.
Mm-hmm. Thanks, Roelfien. Jeroen, I wonder what your clients tell you in terms of how you should use derivatives on ESG portfolios.
Yeah, sure.
So presented back to them as well. How's it incorporated into a mandate, for example?
Yeah, so I think if you look at equity portfolios today at an investment partner, so on the listed equity side, we use derivatives for example, liquidity management or transitions, big transitions in terms of flows. So their derivatives can, of course, be quite useful as well. There, I think it's important, again, to come back to what does the derivative basically represent in terms of underlying universe. So if we have a sustainable fund and we want to use a derivative for the liquidity management, you would actually like to have that derivative also on a sustainable universe. So if the fund itself excludes tobacco, preferably the derivative does that as well. And that is what clients are asking of us as well. I think one thing to be then very mindful of is, let's say, the tilts that those universes, those underlying universes can have. So some of the ESG benchmarks have very high tracking errors versus the mainstream benchmarks, because they are very underweight energy, for example, or certain sectors. So that is very important to be mindful of the tilts and the tracking errors. So what we look at actually, and we actually have launched some solutions for that as well, is actually products that make very active decisions when it comes to ESG and sustainability, but then implement that in a very low tracking error passive way. So you mimic the risk return of the mainstream universe like MSCI World, but with a very sustainable universe. And those are excellently suited then to use, let's say, when you want to do liquidity management or transition management, because you basically abide by the spirit of the sustainable or impact fund itself.
Can I be slightly devil's advocate there, Jeroen?
Sure.
In that type of description, if I understood it correctly, you're effectively gaining an economic exposure to a footprint that you've stated in your policy you want to avoid, whether it be tobacco sector or, you know, a sector that you might want to avoid as a client, or for a very good reason.
Well, so we know we actually do that differently. So what we do is we do exclude tobacco. We do exclude poor behavior in terms of the companies, so breaches of UN Global Compact. We do positively select on carbon ambitions, negatively select maybe on carbon emissions. That basically, if you start with the MSCI World universe of 1,600, 1,700 stocks, brings down that universe to 1,000 stocks. But then through optimization, you can optimize the combination of those stocks that are left in such a way that you lower the tracking error as much as possible. So you get roughly the same risk reward as the starting benchmark, MSCI World, but with a much better underlying universe. So then you do not own tobacco, but as a proxy for tobacco, you own a very sustainable company that has the same risk reward characteristics. And through that, you basically bring down the tracking error and the financial risk. And then it is very suitable as a proxy for the overall universe, but then in a very sustainable way. Hope that makes sense.
Yeah, I think so. Niels, I don't wonder whether you had anything to add again from your own kind of perspective here on you know, the specific benefits derivatives have, and maybe we lead into the next topic, which Roelfien mentioned there, about how, you know, derivatives can be used to increase the allocation of capital to maybe more illiquid asset classes, infrastructure, renewables, and through that improve impact, improve outcomes in the real world, really.
Yeah, no, absolutely, and I think the panel have already put it quite well. But I think just sort of from going a few years back in time, the way we thought about it and initially thought about it in an ESG portfolio, I think for the majority of clients we talked to, we launched the first sustainable pension plans in Denmark in 2018 and 19. And back then there was almost a trend that if you were looking for a sustainable or an ESG product, you wouldn't want to put too much sort of financialization or too many complex products in there without sort of a relevance to the real world. And that was the thinking back then. And Ulf put it very clearly in the discussion around bonds earlier that of course they might very well have an influence in the real world, but that was at least a thinking back in the day, that you'd want a fairly simple portfolio in that regard. That has changed over time. First, sort of you'd want to include derivatives to hedge all the risks you'd normally do in a portfolio, basically, and then over time we see more of sort of our advanced clients that are looking to take specific, looking either to hedge themselves against a specific risk or taking active stance on something. As an example, stranded assets or fossil fuels or something else. And I think if we sort of turn towards the second question here on what is the role that derivatives can play here, it's a big question, but if we look at it in the context of the EU's new Green Deal, we're looking at reallocating around €1 trillion to greener investments over time. And basically, I think the way we think about it, derivatives will have to play a very important role, because if that amount of capital is to be reallocated towards greener goals, there will be all kinds of risks, ranging from traditional interest rate risks, currency rate risks that do change, as Roelfien put it, as, for example, you make this certain commitments, and sort of to smoothen that allocation, basically, there will be a need for derivatives. There will be a need for all of the qualities that those products come with. And I think that will be a game changer. And the final thing here is, when we started the company back in 2017, we thought of ESG and sustainability as sort of the least automated, least digitized area within asset management and finance. That is changing very rapidly right now, and there is a range of new solutions coming to the market. And I think where that will spill over into the derivatives market is all of the creativity, basically, you've seen around other types of derivatives will be necessary, and will probably also come into the ESG space in the next years. And I think that will drive a lot more opportunities for investing in green and impactful projects, but with all of the benefits, basically, you'd know from more traditional investment processes. Thanks,
Niels. Roelfien, I know you've kind of had a career of allocating capital in various different ways. I wonder whether you had any thoughts around that, around the role derivatives play for financing real world outcomes, really.
I mean, the thing with derivatives, right? I mean, for one thing, it's a great way to go short and hedge market beat and all those things. But the real power of derivatives is the fact that they provide leverage, right? So you can take outsized positions in stuff that you think is interesting or alpha generating or similar, without putting down as much capital as you would have if you tried to trade it in cash. You can leverage up the return potential. We put out this trade note I commented on a little bit earlier on, going short risk on Total, the oil major, versus long risk on Equinor, the Norwegian oil major. And there's no way you can make the economics of that trade work if you try to do it in cash. But if you do it in derivatives, you can lever up the exposure you get there to actually get some sort of interesting type of return profiles from it. So it's a very good way to have concentrated views on ESG facts, and this one goes along with the International Energy Agency's new net zero plans and around new oil and gas exploration, etc., etc. And you can take a focused view on that for your portfolio and get it in a way that actually hits the return and yield bogeys. I think that's really the power, because if we believe in the ESG strategy, why don't we lever it up? It should be levered up 10 times. It's becoming more impactful and a higher return driver for us in that case. So that's, I want to beat the drum for the leverage that you get through it as well.
You mentioned also about the recent IEA kind of announcements regarding investments in fossil fuels more broadly. Clearly, it's over a long period of time, that as well. I just wondered how, in your mind, you matched up perhaps short-term perspectives in terms of investing and those long-term views, which maybe, or scenarios which are built up over 10 years, maybe 15 years, perhaps even longer.
Well, I'm a fixed income boy, right? So I like, and I actually wrote a book on curve trading once upon a time. And that's super interesting, because in fixed income, you can really trade the time differential. Do I think this is credible in the 3, 5, 7, 10 or 20 year sort of perspective? And I think there's going to be, and Niels mentioned this as well, right, with regards to the credibility of net zero ambitions at different time horizons, etc. There's going to be an enormous interesting sort of dimension to trade in there. What works out in the short term, what works out in the long term, and what doesn't work in the long term. Why are you buying Saudi Aramco 30-year bonds? Well, you're sort of pricing it from a 3-year or a 5-year point right now. And derivatives can play a massive role in terms of being able to give exposure to investors to produce views on these type of time perspectives.
Fascinating insight in structure of the bond market. Jeroen, Roelfien, I wonder whether you had any kind of further thoughts. I mean, Roelfien, you mentioned it a bit in your earlier response, but whether there's something else to add on that. And
yeah, thank you. I mean, I've been following the discussion, and it's been a very interesting discussion, and I hope the viewers think it's interesting too. And we've touched upon a lot of different elements. I think one word that we haven't really mentioned, I mean, maybe it came up in some of the answers, but I think it's an increasingly important part of the whole ESG discussion, whether we're talking cash or derivative instruments, it doesn't really matter. But that word is transparency. There is more and more transparency around. I liked Ulf's example of, you know, Canadian investor who makes a big commitment to net zero, but then is financing a whole load of companies through their fixed income portfolios. Or I liked Jeroen's example of how you may have an underlying equity portfolio that excludes ESG, and then have derivatives that maybe include. The example was that an equities portfolio that excludes tobacco, but then you have derivatives that may include tobacco or other non-ESG savvy companies or sectors. And so if I look at sort of 20 years in ESG investing, the rapid transformation that's taking place at the moment goes back to that word, transparency. There's more and more transparency within companies. Is it enough? No, not yet. Do we need deeper and more pronounced company disclosures around all these issues that we've discussed about? Absolutely. Do we need to ask as investors, what are proceeds going to be used for? There's a whole green bond market, but for example, at DWS, when we look at every green bond investment, we're not deeming every green bond a green bond. Again, there is marketing within the green bond market as well, and it's important to engage with these companies and really understand where these proceeds, you know, what the lending is ultimately for. So if I just compare today, 2021, to even 2018 to 2016 to 2010, the amount of transparency that's taking place is really significant. And the more accounting standards at companies' levels can improve and include more transparency, more data, then data providers like Niels have more tools to ultimately provide the data that investors are so very much looking at. So this whole transparency issue, we've maybe touched upon it a little bit in our conversation, but you know, whether you're a derivatives investor or not, or a cash investor, it doesn't really matter. It's that transparency that is absolutely needed to make the right and best informed investment decisions.
thanks, Roelfien. Jeroen, again, you know, to that point on capital allocation and the use of derivatives to increase allocation to kind of projects, assets that result in real world impact. Just look around that from your own perspective. I don't know whether you use derivatives within impact portfolios you might manage at NN.
So I think today the use of derivatives is still fairly limited. What Niels indicated before as well, I think we started, especially on the listed equity side, with really stock picking portfolios when it comes to sustainability and impact, and not using too much derivatives. So we might use derivatives in case of liquidity management or transitions. I think coming back to your broader question, I was reflecting a bit at what is the key role for derivatives. I think it can be a very important role in general when you think about asset allocation. And for me, it's really about managing that risk, what Roelfien and also Niels indicated before as well, to make it actually easier for market participants to invest in certain projects, because you can better manage risk because the derivatives are there to manage that risk. I think that's one aspect. The second aspect is around liquidity management, where I think derivatives can play a key role. I was reflecting also a little bit on what Ulf said on the leverage side. There I was myself struggling a little bit. I think in certain situations that can actually help. In certain situations, I think it helps the financial returns, because you're basically leveraging the financial returns because you believe in that positive impact. I'm not sure if it helps the real life impact, because if I invest €1 in a company on the green bond side, I can maybe leverage it 5 times through derivatives, but still that €1 is going to that company to invest in real life. So there, in some instances, I think the leverage can help. In some instances, you might think about, am I influencing the financial returns or also the real life impact?
Thank you, Jeroen. We're coming towards the end of our time. I think we've got 3 or 4 minutes left. There was one question from one of the panelists regarding the product offering within the ESG landscape, as it were. I wondered whether the panelists had any views about missing bits of the product suite that investors, institutional investors, all retail investors, I guess, as well, could utilise to increase their allocation to this particular kind of style of investing.
I think that question depends very much where you sit within the world. I think within the EU, as Jeroen mentioned, the SFDR and the creation of Article 8 and 9 funds gives investors, institutional investors, retail investors, a lot of options to invest in sustainable funds. I think where this becomes more of an issue is, for example, the United States. I mean, it's behind. We talked about the SEC. They're now looking for commentary from investors around the ESG agenda. We have Department of Labor rules that were created that stifled ESG investing under the previous administration. So I think if you are a US retail investor or an institutional investor, the optionality to invest in a lot of different ESG strategies is just limited. And then if I look at Asia, where we have a very significant business as well, it's a little bit, it's growing, and it's growing very fast. And actually, if you look at fund flows, for example, in the first quarter and last year, fund flows were very much moving into ESG solutions. But I would say that there are not enough of these ESG solutions yet for institutional or retail investors. And I mentioned earlier with my example of infrastructure investing, investors are more and more looking for outcome-based investing as well. And I think that there's still a shortage of real outcome-oriented strategies for retail and institutional investors to invest in. I think there's more for institutional investors than there's for retail investors, but the demand for outcome-driven strategies is clearly growing exponentially.
Thanks, Roelfien. Well, I wonder whether you kind of had a final word from a fixed income perspective on the likes of green bonds and that not so much niche kind of line of products anymore.
Yeah, no, I love green bonds, and it's a great product and it's a good way to go long. But in terms of the products offerings in general, I'll go back to what I said before. I think there's a big need for the sort of the inverse products as well, that where you can actually buy protection, you can hedge yourself vis-a-vis, for example, the fossil sectors or certain coal companies, etc. One of the bigger sort of ESG trades I did was to short via CDS, a coal utility company in Europe back in 2015. It was a fantastic trade. But if I hadn't had the CDS there, I wouldn't be able to short it because cash repo is really expensive and so on. It's a big coal operator in India. Building a huge coal mine, and that's something I think there are some interesting trading dimensions around, but I can't trade it right now because, well, I'm not trading per se, but there is no CDS being made in the being marketed on that one. But also on the index level, I want to have a selection of the real bad things that I could easily access, and sort of, if I want to hedge a market downturn, I'd rather buy protection and sort of implicitly raise the cost of capital for the bad guys in that general economic downturn than to go ahead and do it on the general index. So to be opportunistic with ESG in that sense, and there's, so not only sing the beautiful story of ESG, but take the backside of it as well.
Great, thank you. Niels, one last word and then we'll tie up.
Yeah, and of course I don't want to sound like the spectator here, but I think what would be interesting is some of the things that Ulf is talking about here. When those insights come to the fore and when it becomes clear sort of in public perception, what is actually, for example, the risk premium for a specific oil, coal or oil or gas or something like that, what is the implicit premium you'll be paying for that kind of risk? I think that will have massive consequences. I think that will be interesting. Of course, it's not a product, but once sort of those investment strategies become a little bit more known in public light, I think that will also influence a lot of decisions. I think it'll be interesting to follow. So
great.
We'll read the newsletter at least.
We're at the half past the hour, so I think I'll tie proceedings up here. Hopefully we've touched on a number of the questions that have come up on the chat function as we've been going along or at the end of the session. I think I'd just like to finish by thanking our panelists this morning, Roelfien, Ulf, Niels and Jeroen, for their great preparation for this panel this morning. Hopefully the listeners have found it very interesting. We covered a lot of different areas in what I suspect is a newish area for some of the listeners this morning. So thank you very much. Thank you to the panelists, and I'm sure that comes from the Global Investor Group as well. I'll hand back now to Philippa, who I think will take you on to the next session.
Yeah, thank you all. A lot to think about there. I want to say a big thank you to all of our panelists for sharing their expertise and insights into this important issue. Next up, we have our final session of the event, Commodities of the Future, Entering the Super Cycle. We will be back at 1 p.m. for that. So see you there.